I'm down $8,800 on Fortinet stock after the stock just completely cratered, down 23%. In today's video, I'm going to talk about a couple stocks like this and whether or not Fortinet, down now $9,000, is a buy or a hold, or should I just get rid of this thing before it gets any worse? In today's video, I'll talk about Fortinet. I'll talk about several other stocks as well that are in similar situations where we've seen stock slides and whether or not there's some opportunities to pick up some discounted stocks in the meantime. Without further ado, let's jump into the video. So first of all, what's going on with Fortinet? It's down 9,000 bucks on my account. I have 400 shares, and this is clearly a mega sell-off here today. I mean, this is a giant move, 24% for a cybersecurity company. If you don't know what Fortinet is, it's a cybersecurity company. They build all sorts of software, infrastructure stuff to combat all sorts of online security stuff. But what might come as a surprise is that the earnings actually beat estimates, and so did the revenues. So why did the stock drop so violently and is still dropping? Well, here's the oversimplified view. Fortinet plunges as Q3 revenue outlook falls just short of market estimates. So while Q2 looked strong or looked pretty good in terms of the earnings and revenues, it's all about forward-looking stuff when it comes to stocks. And so Q3 outlook is disappointing the market here today. People a little uncertain. And the outlook basically being downgraded is definitely not an exciting thing to investors who want to see this company growing massively and forward projections getting better, not forward projections getting worse. But the question becomes, with a stock sell-off like this, I mean, just look at the daily chart, right? Here was a company that, jumped up quite a bit, giving back a huge amount of gains in a very, very quick sell-off here today. The question becomes, is this looking a little bit oversold? And just look at my extension zones indicator and it looks really wonky here with this giant jump in volatility. Well, although the stock price looks horrendous, let's take a look at the financials. So when I look at Fortinet's financials, we take a look at some of the statistics here, like for example, the trailing 12-month PE. It is high at a 40.56 rating, but remember that some stocks are priced expensive because they have a lot of promise. Cybersecurity is an area of the market that I'm very bullish on for the longer term, and so with the 3-year historical average being slightly above where it currently is, this is actually, to me, not a bad reading. Moving on to the forward PE, it's actually lower than its 3-year average. Price to sales also comes in a little soft. The debt to equity looks okay at 0.48. Revenue growth a little bit slower, which is a little less attractive than its 3-year average. Earnings growth looks pretty good. Return on equity looks pretty good. Profit margins and gross margins look okay as well. And for the last few months that I've held this stock, it's really gone nowhere, but with a good earnings number and this huge sell-off, I actually think that the market may be a little bit overreacting to a little bit of a less clear outlook for the next quarter. So in my personal view, this may actually be a stock that I pick up some shares here of today. Huge sell-off. What I may choose to do is sell a cash secured put around current levels just to collect some income in the meantime. In case the stock wants to keep going lower, I'll still collect a premium. I do already have a pretty good size position, so I would only really be interested if we were to continue to see this sell off for a few days, which is possible. Sometimes you get these huge sell-offs and sometimes they snap back pretty quickly, but such a big sell-off, I wouldn't be surprised if we do see this thing trail lower as sort of the growthy investors may be jumping ship here, right? So companies that are growing revenues dramatically and showing signs of growing them even further in the future, there's a growth cohort of investors who love stocks like that. But once you fall out of favor, there is oftentimes a little bit of a drift away as people who are interested in it for that reason kind of bail on the stock. So I actually don't mind that at all. I would love to buy those shares from people if we continue to see a sell-off in the stock price here today. So I am looking to potentially add shares to my existing Fortinet position, despite it being down almost $10,000 for me now. With the help of the stock analyzer, I'm going to give this a check mark, and this is a buy the dip opportunity for me personally. Not financial advice, but this is what I'm looking to do. By the way, if you don't have access to the stock analyzer tool, complimentary of the stock box, the stock box is on super sale right now. If you're a fan of the channel here and you like looking at financials and looking at macro data and technical screeners and sentiment tools, if you're a stock market person and you want to start analyzing stocks at a greater level, check out the stock box. I'll leave a link in the description down below. And if you click the first link, let our support team know that you watched today's video and we'll give you 45% off the tool. Heads up, this is also just a one-time payment to get access, and it is our biggest discount of the year, so don't miss it. 45% off is happening right now. Click the first link in the description down below. And Fortinet is not the only one that's under pressure. Here's another very popular stock in the retail world, which is e.l.f. Beauty. It's a stock that I like too. It sort of plays the role in the cosmetics world, the makeup and all that sort of stuff, of a company that has a more affordable but still value product. Now, I'm not a big makeup person, as you can probably, well, maybe, you know, I might look good in some makeup, but I'm not a makeup person. But this company sort of plays the consumer role that I think is very, very prevalent in today's society, where prices have gone up on everything. People still want value. You know, ladies and some guys still want to buy makeup, but they want to do so where they get the best bang for their buck, right? They want some quality. They want so that sweet spot is, I think, where e.l.f. Beauty lives, and it's why the stock has done really well in recent years. I mean, if you scroll out, yes, it's come down, but in the last multiple years since the pandemic, stock has absolutely jumped dramatically. So I'm actually looking. I've owned this stock in the past, and I made some good profits on it. I'm looking to get back into the stock. We did get some good, some good earnings relative to expectations. Earnings came in better than expected. Revenues also slightly beat as well. But e.l.f. Beauty's profits fall 30% as China tariffs weigh on bottom line. So e.l.f. Beauty beat Wall Street expectations on the top and bottom lines in its fiscal first quarter, but new China tariffs are weighing on its profits, which were down 30% from the year ago period. The cosmetics company's sales grew 9%, marking the second quarter in a row in which revenue growth slowed to single digits. And this is why, again, stocks are sometimes challenging. It's not about whether or not the company is making more money. It's about the rate at which the company is actually growing. If that growth slows, growth companies become very unattractive very quickly and can have very volatile price corrections, like we've seen in Fortinet and in e.l.f. e.l.f. just closed its acquisition of Hailey Bieber's beauty brand Rhode, and the effect that it will have on its performance won't be seen until later in the year. This was a big acquisition for them. They bought Hailey Bieber's brand, which of course carries a lot of strength on social media. So we'll see how they implement that into their system. But this is a stock that's been on my watch list forever. And if it does continue to sell off, it may be a stock that I add to the list. Unfortunately, I don't have e.l.f. in the stock box just yet. We do have a very comprehensive list, but I just want to give you a heads up that in the future, we will have e.l.f. Beauty. It is one of the stocks that are on our to-do list. We're implementing new stocks all the time to the product. But in regards to e.l.f. Beauty, if I scroll out, this is a stock that I think longer term will move higher from where it currently is. And so if it does continue to dip, there may be an opportunity in my personal view to pick up some shares. The way I probably would do this, as I do most of the time when entering a stock, is actually sell a cash secured put out of the money on e.l.f. The stock is moving lower here today by about 11.4%. And so I wanted to also take a look at what it would give me to sell a cash secured put. If I'm looking left in terms of price action here, we've broken out of this range. This gap may be an area of support. Let me just see what I would get, for example, for an $85 strike price cash secured put. So I'm going to go out 30 days on this. The closest one is this 29 days. And let's just say that we are looking to sell cash secured puts, and the strike price that I said was $85. So this is roughly, you can see it's kind of spready in terms of its spreads, but let's just get an idea of 1.08, which is the mid price on this. So I would get paid for selling, this would be for 500 shares. For 500 shares at $85, that's going to be a little bit too much. So let's say I actually halved that, and let's do 200 shares. So for 200 shares times 85, it would be a commitment of $17,000. Now there is a way to do this where you don't have to commit this much capital. It's called credit spreads. You can sell a bull put spread if you want to look that up. But I actually have a video on the topic, which maybe I'll link it in the top right hand of the screen if you want to go through how to trade options the way I do. I have a video on this topic. But let's just say for me, this is something I'd be willing to potentially commit to e.l.f. Beauty. So if I were to do 2 contracts, that's 200 shares, and let's just bump it to what it currently is offering, it's $1.18. 30 days out, I would collect a premium of $236 in exchange for committing those funds to buying the stock if it were to drop substantially from here. To me, that's not particularly attractive, but if we do get a couple days down, on the stock, if we see, another day or two, that implied volatility being high could generate some really nice returns. Let me just also see if I were to kind of tighten up to the $90 strike price, what kind of premium would I get on that? So if I go and I look at the $90 strike price, this is 30 days out to September 5th expiration date. I'm selling a put. What would this give me? Well, $2.88 per share, which is a pretty decent return on a $90 strike price. So we'd be talking about on, let's say, 200 shares, that would be $576 in premium. That might be worth it to me. So I'll keep an eye on this. If I take this trade, I'll share it inside of our Discord group, which is linked in the description down below, where I post all of my trade updates there. The pain train on Robinhood stock continues for me here. I am long the stock, but as I've discussed many times on my channel here, I have what is called a covered call position, meaning I own 600 shares, but I've also sold 6 contracts, which represent 600 shares of out of the money calls, which are now in the money because the stock has gone up so much, meaning that I'm floating a loss on my existing shares of $4,000. So even though I have a really nice profit on my shares, I'm giving back some of those through the calls that I've sold. What this also means is that if by expiration or at any point that the options buyer, the person who bought these calls from me, wants, they can actually execute their contracts, meaning I would have to sell my shares at $95 per share, even though the stock price is trading at 108. This is the downside of selling covered calls, but I've also done really well on several other stocks. For example, if I take a look at like AXP, you can see I've got a nice profit on this one from the calls that I've sold. I'm up $305 here. I also sort of cushioned myself here with the Airbnb drop off. In fact, this is our next topic here. Airbnb dropped off on its earnings, and the calls that I sold, you can see they're up just about 100%. So I made $962 for selling the 142 calls. So I sold that bet to someone else, and that bet is essentially worthless now. The downside to this is that I'm pretty much back to break even on the shares that I own of Airbnb, but I essentially hedged my risk with these calls that I sold, collected almost $1,000 for selling them. The main negative catalyst for Airbnb is that it expects slower growth in the second half of 2025, and that is the large reason why several of these things are showing negative returns. So Airbnb had good top and bottom numbers as earnings and revenues, but the expectations for future growth have been slowed by the company's forecast. So that is what is causing the stock price to slide. Airbnb was actually a trade that I placed during the sell-off that we saw in April. Travel stocks got absolutely slammed in all of the tariff trauma that we saw in April, and I bought the dip on things like Delta Airlines and Airbnb. The bounce back since then has put me into a position where these stocks, in my view, are no longer super attractive to buy on. We still have kind of an expensive stock relative to its 3-year average. I guess it's about even. The forward PE looks okay, but it's not a particularly attractive stock to me. But with the sell-off here, it does bring in the valuation a little bit on it. So I'll probably just keep it in the portfolio, but I'll probably still just sell out of the money calls on Airbnb until I get called away from my existing position. Again, this gives me the opportunity to sit on the shares and wait and collect income in the form of calls that I'm selling. So I'm selling bets that the stock will go up. So I don't necessarily care if the stock goes sideways. I actually prefer it. If the stock goes sideways, I just collect premium and I get to keep my shares. If the stock were to erupt higher and move to the upside, then I would collect income from the calls that I sold and price appreciation on the shares that I own. Today's video is sponsored by Moomoo. And if you haven't heard of Moomoo before, they're a one-stop global trading platform with over 26 million users across the US, Australia, Singapore, Canada, Malaysia, and Japan. And Moomoo offers $0 commissions on stocks, ETFs, and options trades. They also offer free level 2 data and real-time options chain data, no extra charge. And the Moomoo platform is super advanced. They offer a really powerful options trading tool, and you can even track latest public figures holdings like Nancy Pelosi's directly within their portal. And if you want to learn something about a particular stock, just ask Moomoo's AI feature. With this tool, you can ask for trading insights on your favorite stocks. And if you want to tap into what institutions are buying and selling, check out their institutional tracker. This tool allows you to explore top institutional holdings. What sets Moomoo apart is their incredible platform for researching stocks, checking out all sorts of different analyst rating tools, and insider holdings and trades. And for a limited time, as shown on the dates on the screen right now, you can get up to $1,000 in NVIDIA shares, plus 8.1% APY for US users. As you can see on the screen, please follow the criteria here and make sure to use the link in the description to get the full context behind this offer while it is available. It is available for only a limited time. And are you already trading with another brokerage, but all these tools sound pretty cool? Well, I think so too. And they're currently offering a really cool 3% match on the first $1 up to $20,000 transferred from another brokerage. So if you're looking to take your trading tools to the next level, check out Moomoo and take advantage of some of the offers available using the link and details in the description of this video down below. Now back to the video. Our final stock that we're going to talk about today is UPS, which has been already in a mega downtrend for the last few years. Take a look at 2021, 2022. We saw the highs of this stock and it has been sort of grinding lower over time. This one was really hot and popular during 2020 and 2021 and has since just couldn't get out of its own way. The main reason for this, when we pull up the stock analyzer, is declining earnings and revenue growth. Now, while the stock is now cheaper than it usually trades for relative to its earnings, this is still a stock where I'm a little bit cautious because you're talking about, okay, yes, the stock is cheap both in the stock price, but also the price relative to its earnings. That has become the case. The challenge that you have with this is you also have negative revenue and earnings growth to go with this. So if the PE ratio is falling because you're having dramatic, revenue and earnings growth slowing, that's a challenge. USP disappoints the market. The package delivery company missed earnings estimates, declined to update on its full year guidance again. Management did this on the first quarter earnings call in April, cited volume declines in its most profitable international trade lane, which is China to the US, and served notice that one of its key end markets, the small and medium-sized business, are being inordinately impacted by the tariff conflict. And for me personally, this is why this stock is just not really a buy. Now, there may be something that turns around, and maybe this is the sort of company that certain investors like to look for. The value investors, maybe they're looking for some sort of reversal, some turnaround game plan here. But for me personally, that's just not typically the type of stock that I like to prefer to buy. I like to buy stocks that have growth in their earnings and revenues and are on sale in the meantime, which is hard to find. And sometimes you get stock prices that are moving lower just because there's sentiment or worries about the company. But sometimes you get worries about the company that are more valid in the form of declining earnings and revenues. So there are some stocks that I own that I want to reduce my position sizing on, like Tesla, for example. I have a good size position, but this one has also been having a string of disappointing earnings and revenues. So this is a stock that I'm actually trying to cash out on to some extent. I'm waiting for a pop to get out of some of my positioning in this stock. Earnings and revenues over time are ultimately what cause the stock to go up or down, and the sentiment around the stock is also key. So when I look at something like a UPS, this would probably be one that I'm personally passing on for now. Remember that if you don't have access to the stock box and you'd like to try it out, there's a link in the description down below to sign up for a 30-day trial, or if you send us a message using the first link, you can get 45% off for a limited time. Check it out. Thank you very much for watching.